Welcome. If you've been paying attention to, finance or technology over the last few years, you've definitely come across the acronym DeFi, decentralized finance.
Oh, for sure. It's everywhere.
And for most people, it really just exists in headlines. It's either promising these incredible overnight riches.
Or, on the other hand, these spectacular, really complicated collapses.
Exactly.
And that's precisely why it's so confusing for so many people. They see the crazy high yields and the complexity, and they tune out.
Right.
Our goal today is to cut through all of that noise. We're starting a new project, something we're calling the DeFi Manual series.
A user manual. I like that.
Yeah, we're going to treat this whole subject like a foundational user manual for a new, and I have to stress, experimental financial system.
That's a great frame for it. So our mission in this first conversation is purely foundational. We are not here to tell you what tokens to buy.
Absolutely not.
We're answering three, I think, really essential questions. What is DeFi? Really? Why did anyone even feel the need to create it? And maybe most importantly, how should we, as thoughtful users, analyze this infrastructure beyond just chasing the highest advertised APY?
We really need to shift how you approach the topic. If you focus on the volatile tokens, you're just looking at speculation. It's a casino. But if you focus on the underlying infrastructure, the code, the rules, the risk, you start to gain a durable understanding.
Okay, so it's about building that mental model from the ground up.
Exactly.
Okay, let's unpack this then.
Yes.
We kind of have to start where most people start, which is the surface level.
The flashy stuff.
Yeah, what does DeFi look like from the outside? It's those screenshots of like 1,000% APY on social media. It's yield farming, staking weird tokens. And let's be honest, it's often the fear of just rapid financial loss. It has this reputation for being a very high-stakes, very volatile casino.
It absolutely does. And look, those casino elements are definitely real. They're well publicized for a reason. But they are a symptom, not the core project.
A symptom of what?
The underlying experiment is it's far more serious and ambitious. DeFi is an attempt to take the essential functions of traditional financial institutions. The lending, the borrowing, the trading.
All the core stuff a bank does.
All of it. And rebuild those functions entirely as open source, auditable code that's deployed on a public blockchain network.
So we're talking about replacing private ledgers and hidden bank servers with transparent code that anyone could look at.
That's the goal.
That shift in perspective from gambling to infrastructure, I think that's what makes it all click. But I mean, that raises the big question. Why bother?
Right.
Why spend all this effort rewriting the rules of finance and code when we already have banks and apps and credit cards that, for the most part, they work?
To understand why DeFi even appeared, you really have to get the systemic frustrations with what we call traditional finance, or TradFi.
Yeah.
Even the modern fintech apps, the ones that feel really fast and sleek on your phone, they still connect to infrastructure. The banks, the ACH network, Visa that was built decades ago, was built for a pre-internet world.
And those old rails have these built-in limitations. We can probably break them down into 4 major friction points?
Yeah, 4 is a good way to think about it. The first is simply time and geography.
The classic 9-to-5 bank.
Exactly. Imagine you're a business trying to send a large transfer from, say, Europe to Asia. That money doesn't move at the speed of the internet.
Not even close.
Yeah.
Especially on a Friday afternoon.
Perfect example. It goes through a whole series of intermediaries. It takes business days. And like you said, if it's Friday, you might be waiting until Monday. Traditional finance just isn't a 247 global instant system.
Okay, so that's one. Then there's the frustration of access and permission.
Huge one.
If you're a talented developer in a country with, say, an unstable currency, or if you just have a low credit score, you might be totally locked out of certain financial services.
Forever. It doesn't matter how good your idea is. The system requires you to ask for permission, and that permission is often denied for reasons completely outside of your control.
Which leads right into the third point, doesn't it? The opaque rules.
Yes. When you apply for a loan, the bank's decision is made by some internal software, some private risk model you'll never see.
You don't see the logic.
You just see the result, approved, rejected. You were charged a $45 fee. The actual rules of the game are hidden inside a private database that only the institution controls.
You're forced to trust the intermediary because you can't inspect their process. Okay, and the last one.
The fourth frustration is fragmented infrastructure. The U.S. has ACH, Europe has SEPA, and every single region has its own proprietary local network.
They don't talk to each other.
Not naturally, no. To connect them, you have to layer on dozens of expensive intermediaries, which adds massive cost and complexity, especially for international business.
So the core question driving the builders of DeFi became, can we just eliminate those 4 friction points? The time zones, the permission, the hidden rules, the fragmentation.
Can we do that by building a global financial system that runs not on private bank databases, but purely on the internet itself?
It sounds great in theory, but a system like that couldn't have just popped up overnight. I mean, what ingredients were actually necessary for this to become technically possible?
Right. It really needed a convergence of 3 major technical innovations. If any one of these 3 didn't exist, DeFi as we know it, it just couldn't function. Ingredient 1 was Bitcoin, digital scarce money.
The original?
The original. Bitcoin showed the world, for the very first time, how to create a digital asset that was both decentralized, so no single entity controlled it, and genuinely scarce. It solved the problem of digital consensus.
So Bitcoin gave us the asset, the decentralized value. But here's the key thing, right? Bitcoin alone wasn't enough.
Not for this, no.
Its base layer has very limited scripting capabilities.
Yeah.
You can send it, but you can't easily program complex financial logic into it. You can't write code that says, if the price of this asset drops, automatically liquidate this loan.
Exactly. You needed a way to build complex logic. And that brings us to ingredient 2, Ethereum, or more broadly, programmable contracts.
The world computer idea.
That's the one. Ethereum introduced this concept of a public shared platform where anyone can deploy these self-executing programs we call smart contracts.
And the significance there is it's massive.
Yeah.
These aren't just simple transactions. They can be entire, fully functioning financial protocols.
And critically, these programs run exactly as they were written. The rules are public and auditable because the code is right there on the blockchain for anyone to inspect. It turns money from a static thing into a programmable tool.
Okay, so we have the asset, we have the programmability, but there was still a huge problem, volatility.
A massive problem.
If you want to build a loan product, you can't have your unit of account swinging 15% in an hour.
It's impossible. You can't conduct routine business or set stable interest rates.
Which is why ingredient number 3 was so essential, stablecoins, a relatively stable unit.
This was the real aha moment.
Right.
These are tokens designed to maintain a stable value, usually pegged to the US dollar. They provide the predictability you need. They allow builders to create financial products, savings accounts, loans, trading pairs that function reliably without constantly exploding every time the market gets volatile.
So when you connect those 3 dots, you have the digital scarce assets,
Yep.
plus the programmable contracts,
Right.
plus a stable unit of account. That's the recipe. That's what creates the fertile ground for DeFi to actually exist and function.
With that foundation built, let's try to solidify our working definition. DeFi, at its core, is really just a set of financial services like trading, lending, borrowing, implemented as open smart contracts on public blockchains.
Let's break that down, because so what part is in those terms? If we say financial services, we're confirming this is about core bank functions, not just speculative tokens.
Correct. And if we say open smart contracts, we are stressing that the rules are public and auditable, which is the direct opposite of the opaque rules in TradFi.
And on public blockchains.
Yeah.
That highlights the open access, right? Anyone with an internet connection and a wallet can interact.
No middle manager, no bank executive needs to approve your participation.
This architecture gives DeFi 3 really unique properties that you just don't see in traditional finance.
Right. The first is that permissionless access we just mentioned. No KYC, no credit check to use the protocol itself.
And the second one is maybe the most transformative. Composability.
The Lego blocks.
The Lego blocks analogy, yeah. Since all the protocols are built on the same public infrastructure, they can be plugged into each other.
And to illustrate the power of that, in traditional finance, you can't borrow money from Bank A, use that as collateral in brokerage B, and then have the profits immediately rerouted to an account at Bank C.
They're all different systems, siloed.
Completely. In DeFi, a developer can write a single smart contract that does all of that simultaneously. Ours from AF provides liquidity on an exchange, stakes the yield somewhere else, all in one transaction, all governed by code.
That seamless stacking of functions is genuinely impossible in our current banking system.
And the third property is protocol transparency. Users can see the rules, the code itself, and they can also see the activity.
So you can see the reserves in a lending pool, you can see the flow of transactions.
Exactly. You don't know the identity behind a wallet, but you can audit the system itself in real time.
Okay. Transparency and permissionless access sound like huge wins, but we have to emphasize that this manual isn't complete without a really realistic look at the risk.
We must. It's critical. Let's start with the 3 undeniable strengths that make this all so compelling. First, there's that global access we talked about, financial inclusion driven by code.
Second is the incredible programmability. We're not just talking about moving money fast. We're talking about automating complex market functions.
That's a great point. A bank might adjust its savings rate once a quarter. A DeFi lending protocol can automatically adjust the interest rate every few minutes based on the precise, real-time demand for funds in its pool.
That kind of dynamic, algorithmic finance is it's beyond what most legacy bank IT systems can handle.
And third, there's open innovation. Because the code is open source, good ideas spread instantly. One team builds a great exchange, another team can fork it, refine it, and innovate on top of it. Innovation moves incredibly fast.
Okay, now for the critical part of the manual, the trade-offs. The speed and the access come with some really profound risks.
They do.
What's the most immediate danger for just an individual person trying to use DeFi?
The biggest shift is in user experience and responsibility. It's all on you. In TradFi, if you forget your password, you call the bank.
There's a reset button.
In DeFi, if you lose your private keys, the things that secure your wallet, there is no customer service line. There is no forgot password button. If you send a transaction to the wrong address, that action is very often permanent and irreversible.
You are your own bank, for better and for worse.
That's it. You're solely responsible.
Which brings us to the second, and I think maybe the scariest risk, smart contract risk.
Yeah, this one is tough. We are dealing with code, and all code can have bugs.
And in this system, a bug isn't just an inconvenience.
No. A flaw in the code, even one that's gone undetected for years, can be exploited by a hacker. And that can lead to the instant, complete loss of all the funds locked in that protocol.
For everyone using it.
For everyone, think of the smart contract as the vault. When a bug is exploited, it's like the lock itself was fundamentally flawed and all the money just vanished instantly.
Wow. Okay. And finally, there's the big one that hangs over everything. Regulatory and legal uncertainty.
Right. While the protocol itself might be permissionless code, the websites you use to interact with it, the stablecoins you rely on, they are all subject to the laws and scrutiny of governments.
So if regulations suddenly change, it can drastically impact the usability of the very assets and interfaces you're using.
Exactly. So the overall message here is clarity. DeFi is not some magic money machine. It is a cutting-edge laboratory where we are testing the limits of programmable finance.
And the risk is shifted.
The risk is fundamentally shifted. It's moved away from centralized institutions and placed squarely on the individual users and the developers who write the code.
That shift from institutional risk to individual and code risk, that's probably the single most important concept to cement in your mind.
I could think so too.
We designed this session to give you that structural understanding of the why and the what. So when you look at a DeFi product now, you should be able to see not just the reward, but where the risk actually lives.
To summarize our first chapter then, DeFi is an ongoing experiment to write the functions of banks and markets as open, programmable code on public blockchains. It's a pursuit of a more global, accessible financial infrastructure, but one that demands profound personal responsibility from every single user.
So what does this all mean for what comes next?
Yes.
We focus today on the context, the ingredients. Next time, we move to the fundamental mechanics, the engines that make the whole thing run.
Right.
We'll specifically explore the heart of on-chain trading, the AMMDX.
The automated market maker decentralized exchange. It sounds complicated, but the concept is beautiful.
It is.
We'll explain how systems like Uniswap completely rewrote the rules for trading by using these things called liquidity pools and algorithmic pricing, a mechanism that gets rid of the traditional stock exchange order book entirely.
And understanding that piece of the puzzle is key to understanding how money moves and how yield is generated in this new world. Stay with us as we continue to build out this manual and explore the specifics of the protocols that power this new financial infrastructure.